Hello guys, what's up? I welcome you all back to my channel, still me Gus FX Trade. In this video, I'll be teaching you guys about liquidity. Everything you need to know about liquidity. Liquidity means money. Yeah, liquidity is sitting above equal highs, which is double top, and also sitting below equal lows, which is double bottom. These are orders or stop loss that the banks need to activate before they can place their position in the market. So before we move further to this lesson, please, if this is your first time visiting my channel, please don't fail to subscribe so that you'll be notified anytime I upload a new video. Currently I'm running a free mentorship this year 2024, and this is the fifth topic of my mentorship. So let's move on. We have types of liquidity. First one, equal high liquidity, which is double tops, equal low liquidity, which is double bottom, range created liquidity, internal liquidity, and external liquidity. We have 5 types of liquidity. So what is equal high liquidity? This is an example of equal high liquidity. What is equal high liquidity? Equal high liquidity are stop losses of sell orders that the banks need to activate before the market reverses to the downside. Yeah, the banks uses this equal high liquidity to place their sell position in the market. As you can see the example here, price broke previous low, was making a retracement and reached close to the supply zone, created equal high, which is double top, then changed character. This change of character must have happened in the lower time frame. Yeah, then changed character here. That will now make early traders start to enter their sell position from here. You see, from the demand here. Yeah, and their stop loss will be above that double top. So as you can see, what happens here is that price now moves up, swipes the liquidity, the stop loss of those early traders that we are selling, and moved to respect the supply above. This is how big players works, the banks, taking out stop loss of early traders. But here this this example of equal high, what they took out was stop losses of early sellers, traders that were selling here, and their stop loss were above that double top. So banks swipe out their stop loss, place their position, and then boom, the trend continues to the downside. And here is another example of the double bottom, changed character, then boom, swipes the stop loss below the double bottom, expecting the demand below, then boom, the trend continues going up. So here, this is where patience plays a huge role in trading. Sometimes you will see price get close to area of interest, which is either your supply or demand zone, and will now start doing something like this. When price gets to close to your area of interest, start creating a double bottom or a double top, then you see this as a price have started going up. Then next thing you see is boom, price sweeps those low, then boom, the trend continues. So this is why you have to have patience. Even if you are going to trade the double bottom or the double top, you have to wait for a trend confirmation, so that you will know that the trend have fully changed from the bearish trend to bullish trend. For example, here, let's say we have something like this. Price now started to make a retracement, then reach close to the, then reach close to the demand zone, created a double bottom, changed character. That's the first one. Then you now wait for another break of structure confirming the trend change, then you now enter. Boom. This is the best way to trade double bottom. Here, as you can see here, price created a double bottom here, which is equal lows, signifying a liquidity. For you to trade it, you first of all, you wait. Yes, first one, price changed character. You won't enter here because there's a possibility of you entering here at that first break, which is the change of character, and you now have is, let me remove this because I'm unable to explain. The next thing you have is price moving down, swiping this double bottom before moving to the intended direction. But let's say, assuming price didn't swipe those the liquidity below, let's say price didn't swipe this liquidity below, what you have to wait after the first break, which is the change of character, you wait for the second break, which is the break of structure, confirming that this trend has fully changed from bearish to bullish. This is where you will now enter your trade. This is the best way to trade, to enter a trade when you have liquidity resting below. So that is it. Let's move over to the next type of liquidity. One moment please, let me clear this out. So the next type of liquidity we have is the range created liquidity. This is an example of a bullish range created liquidity, and this is an example of a bearish trade created liquidity. So what is a range created liquidity? A range created liquidity indicates high volume order with many orders changing hands, and likely large players, which are the big banks, are beginning to stack in orders. Thus they have started to accumulate orders, build in liquidity inside. So as you can see here, price was making a retracement, then getting close to the demand zone, started ranging. What price is doing here, the banks are accumulating order, building liquidity. Yeah, that's what they are doing. And the next thing you will see is boom, price swipes that zone before moving to the intended direction. And here is another example of a bearish range created liquidity. Price was trading bearish and made the retracements, getting close to the supply, started ranging. At that moment, the banks are building order, creating liquidity, and the next thing you will see is boom, liquidity being swiped before price Now moving to the intend direction. For example, sometimes you have something like this also. Price starting to accumulate order. Next thing you have is this. To take this trade, you have, first of all, you wait. This thing that I'm saying now is what you will do at the lower time frame. As you can see, the first one is price swiping the liquidity below that range, clearing stop loss of those early buyers. You wait. First one, which is the first break, which is the trend changing. Second break, which is the confirmation that the trend has changed. Then you now place your trade at the demand. This is it. This entering trade like this gives you more confidence. It's a high probability trade, because most times you have something like this. Price creating a range, swiping that liquidity, making that first break, which is a break of structure. Yeah, we now think that price have, the trend has changed. You will now be expecting to buy. Price will now do what again? Swipe that low again before now starting going to the intended direction. What do you see here, guys? This is why I said in trading you need to be patient. Have patience and wait for confirmation. As you can see here, price swipe the first low, which is the liquidity below that range, then did what? Made the first break, which is the change of character, but the trend is not yet confirmed that it has changed from bearish to bullish. So most traders will be buying here, entering here. Early traders entering here, their stop loss being below. The next is what? Price moving below, swiping their liquidity, then doing what? The trend being confirmed, making another break before going to the intended direction. This is why you have to always wait for this. After the swipe of liquidity, you wait for the first break, which is the change of character, and the second break of structure, you now enter. So that is how to enter a high probability trade. Trading involves patience, because the money is being transferred from the impatient to the patient one. So to make money from trading, you have to learn how to be patient, wait for price to play, wait for the big players to show you their footprints. It's that footprints that you now follow. So let's move over to the next example of liquidity, which is the internal liquidity. Internal liquidity, internal liquidity are previous lower time frame swing highs or lows that is within the higher time frame range. As you can see here, let's say for example here, this black drawing here is the daily time frame. The daily time frame broke structure, while the daily time frame is making a retracement. All the previous 4-hour highs will serve as what? Liquidity. that is what we call internal liquidity. Yeah, I'm saying that this pink drawing is the 4-hour and the black one is the daily. So once the daily has break structure, any high, that's the 4-hour high in the 4-hour time frame, any high that is in the 4-hour time frame while daily is making that retracement, we serve as what? Liquidity. Yeah, that is it. That is what that's the example of an internal liquidity. I will still show you guys a live example of the internal liquidity. As you can see here, the 4-hour was bearish, but after the daily broke the structure, all the highs of that 4-hour will serve as liquidity. Price will be swiping it until it gets to the demand, where to get to the supply, because this one is the example of a bearish example of internal range, until it gets to the supply that it wish to sell from. So you see where understanding market structure comes in, knowing top-down analysis. So for you to be able to understand this, you need to know what structure, because if you understand structure, you know how to read market structure. Once daily breaks structure, breaks the previous low, you know that every high that is in the lower time frame will serve as liquidity. You won't use those highs, previous high in lower time frame, to be looking for opportunity to buy or sell. Yeah, and here is another example of internal range liquidity. Here is a bullish example of internal range liquidity, and here is a bearish example of internal range liquidity. So let's move over to the last example of liquidity, which is the external liquidity. External liquidity are previous higher time frame swing high and lows. Yeah, this is what I'm drawing now. This is the daily time frame. This is the daily time frame, and every previous high of it will be what? Liquidity. Just like when price created this range and made this retracement. Yeah, when daily is making these retracements, it's taking out what? Internal liquidity of lower time frame, and after that, and it reached to the let's say the demand zone where price wish to reverse from, what price will now start to target what is the external liquidity, which is the previous daily high. So this example, a bullish example of external liquidity. Let me show you guys example of a bearish example of external liquidity. Here we go. So this is it, guys. Same example. You have this range. They broke this structure. Broke structure here. And why making that retracement? it will be doing what? Swiping internal liquidity, which is lower time frame liquidity, until it gets to the supply zone where it wish to reverse from. What next it will be targeting is what? The external liquidity, which is the previous daily low. That's what price will be targeting for. I'm just using daily time frame as an example. Same goes to weekly and monthly. So this is example of a bearish external liquidity. So let's move over to live charts and see how it looks like in a Leo chart. So guys, here is an example of equal low liquidity, which is double bottom. Let me increase this so that you guys can be seeing it clearly. As you can see here, price broke the structure, then continues, made the retracement, creating a double bottom here, then continued moving up, then later came back swiping this double bottom, which is liquidity, almost close to the demand again, broke another structure, did as if price have ignored this demand zone, but later boom, price came down and respect that demand zone. You see why I said in trading involves a lot of patience. You need to be patient and wait for price to, you know, reach that your area of interest. If it doesn't, you let it go. It's not a must that you must be in that trade. That's another way to increase your win rates in trading. So let me move to lower time frame so that you can see this double bottom clearly. As you can see it here, price broke that structure, made the retracements, creating that double bottom, then started moving up, came back again, swiping the double bottom, equal low liquidity, ignoring the demand zone, starts to break another structure, then later boom, came down again and respected that demand zone. So vice versa of this same thing applies to double top. So let's move over to the example of a range created liquidity. So guys, here I'll be explaining a range created liquidity and also internal liquidity. As you can see here in 1 hour time frame, 1 hour broke structure here, moved. Most traders will be expecting to buy from this pivot demand, but just like I told you, I gave you guys example about internal liquidity. Once a higher time frame breaks structure, the next time frame that is lower than that one that broke that structure, every low or highs depending on the range will serve as liquidity. Let me show you guys what I mean here. After this 1 hour broke structure, let's move over to 15 minutes. Did you see what happened here? Every low in that 15 minutes, price kept on swiping it out. None was respected. The first one swiped, the second one swiped, until price got to this pivot demand. Pivot demand is generally this 3 candle, but you can refine it to the last sell candle if you want. That's your choice on how to mark your supply and demand, because this is the way that I do my, but pivot generally is this 3 candle, this short move here before this upside move. So as you can see here guys, 1 hour time frame broke structure, and most early traders started to buy from this demand zone. Yeah, and what did price did? Price keeps on moving up as if it's respecting this demand zone. The next thing, boom, price went down, taking out their stop losses. This is what the banks do, taking out stop losses of early buyers depending on the direction of the market. But here the banks took out stop losses of early buyers, then putting in their position here before price now start to move to the direction. And if you can see here also, this is a range created liquidity. Price getting close to this demand zone started doing what? Accumulating order, building in liquidity. And after that, what did price did? The big players first, they broke here. Let me not use this one. They broke here. So most traders, the ones that didn't enter here, will be saying, yeah, this is an opportunity to buy from here, and got in here, setting their buy trade here to ride on with the price. What did price did? Boom, swiping out their liquidity and came down to this demand zone and respected this demand zone. Trading involves a lot of patience and rules. So that is it. And even if you want to trade a range created this liquidity, that's why I said first, after this first break, you don't enter immediately. You wait for another break, then enter, and that retracement. This how to enter a high probability trade. After the first break, which is the change of character, you wait for the second break of structure, which confirms the trend change. That's how to enter a trade, guys. You need patience. One, second, you need to master market structure. You need to know swing points, how to mark out swing highs and lows. So let's move over to the last example, which is external liquidity. So guys, here is an example of external liquidity. As you can see here, daily created this low here, break structure, they made a retracement. After that retracement is being made, what price will be targeting is what is that previous low. That's external liquidity. And as you can see, after that retracement, price went down and swiped that previous low. So let me show you guys something here. Did you see that after that daily broke structure, price didn't respect this 4-hour supply zone? Did you see it? Daily broke structure here, started to make the retracement and liquidate this 4-hour high. This is what I'm explaining to you guys about internal liquidity. After daily broke that structure, while making a retracement, this 4-hour supply wasn't respected. Why? Is because that high of that supply zone is now liquidity. Price need to liquidate it. Banks, they need to swipe it off before placing their position in the market. So know this: anytime the time frame that you are in break structure, for example, let's say made a break of a bullish break of structure. The next time frame that is lower than that one that broke structure, any high, any low within that range will serve as liquidity. Take note of this. It's a price break structure made, making this retracement. Let's say this is 15 minutes. I'm using 15 minutes as example. 15 minutes broke this structure. Why 15 minutes is making this retracement? Every low that is here within 5 minutes time frame will serve as liquidity. That price will liquidate before continuing that move. I hope you understand what I mean, guys. So that is it. I think that will be the end of this video, liquidity. So guys, I don't know why most of you are not yet subscribed to my channel. It doesn't take you anything, it doesn't reduce your lifespan. Please subscribe to my channel. This a way of appreciating my work here. And also you can join my Telegram channel. I'll drop the link below the comment section. You can join for free daily analysis and education also. So guys, make sure you practice, watch this video, practice until you fully understand what liquidity is all about. So that will be end of it. I wish you all good luck and good trading. Bless.